We're gonna start with the classical sampling handout. So tonight, classical sampling handout, we'll start with that. I think we should be able to finish this one. I don't remember this one being too long. And then we're also gonna go back to the chapter 10 handout and we'll see if we finish that one. But anyway, the new due dates for those, I don't know what I was thinking when I put those in, but those will not be due for a couple of weeks. So, okay, so that's what we're gonna do tonight. And so let's pull up the classical sampling. I think I'm going to put something else up here for a minute. I just want to just go over go over a little bit about kind of how you work auditing. The first thing you do is you plan the audit. And the second thing you do is gather evidence. And the last thing you do is that wasn't right. Interpret. So you plan the audit, you gather the evidence, and you interpret the evidence, okay? And this gathering the evidence, this is when you're trying to look for dollar amounts. And in our case, for financial auditing, material misstatements. So this is kind of what this classical sampling is. This is where we're actually gathering the evidence. So classical sampling will fall in here. Oops. Hey, there we go. So classical sampling is sort of gathering the evidence. So we're trying to see if we can find material misstatement. Now, this first one and this last one are extremely important. And this is probably about the split up of your time. Planning the audit, you gather the evidence. That takes a little while, but then also interpreting it and going through the approvals and all this kind of stuff it takes quite a bit of time too. Writing it up. So classical sampling is we're trying to see if there are material misstatements. I'm going to save that. Okay. So we're looking for material misstatements. And we have what are these? Accounts receivable. So we're going to use the first two columns with a random table at the bottom of the page. Example of 5 accounts receivable. Have you guys had sampling yet in your statistics?
No, I haven't.
Yeah. Okay. All right. This classical sampling stuff is very similar to that. And so if you haven't had it, this will be a little bit of a preview. If you have had it, maybe it'll be a little bit of a review. So finding the average book value for a 5 item sample. Okay, so they have 30 items here. Okay, so we have these 30 items. And I don't like those blue. And we want to pick 5 of them. Now, those of you that have had sampling, you know that when you do a sample, it's best to get a random sample. And the reason is for a random sample is that it's unbiased. So a random sample is usually the best. Okay, a random number table. This is a random number table. And they tell us to use the first two columns. Okay, so here's the first two columns. So on the random number table, it says 0, 3. So we are going to pick item number 3. That's gonna be our first item in the that we pick. And this random number, these are all random numbers. And by the way, they're random. Actually, there's a random digit table, is maybe a better term for it, because each digit is random. Okay, so let's go to the next one. Do we have a 46? Is there an item?
We don't.
No, we
No.
don't.
So we can't use that one. So we go to the next one. 51,
No,
32. Closer. No. Okay, 11. Yes, there is a number 11. We'll use that one. Oh, don't mean to do that. 14. So basically anything 1 through 18.
We do have 18.
Yep. And last but not least, 91. No, I guess that's not last but not least. What, 28?
Yep.
Okay. So 28. I think that's 5, right?
Yep. We got 5 now.
Okay, so 1, 2, 3, 4, 5. Okay, and notice now this is random in these random table, and you could pick any columns you want to work with, to pick a sample. We picked the first two. So these are the items we're going to pick to take a look at and try to make a judgment as to whether these are materially misstated. The accounts receivable. Okay, so we have our 5 items. Okay, so item number 3. I'm going to put these in here just to. 3, 11, 18, and 28. I don't know why 14 is off to the side like that. Must have done something. Okay. So we'll come out. I don't think it's copied this or not. Maybe we can. Hey, you can. All right, well, that's going to speed things up. Okay, so you see this first one, they're the same. All right, that's a good sign. Number 11. The same. $14, we got a little bit of a problem there. 18. By the way, I want to show you one more thing here, just to kind of drive home a point. If you look at these account numbers, you'll notice that they're all over the place. So as an auditor, sometimes it's easier just to renumber them 1 through whatever, 1 through 30, 1 through 500 or whatever it is. And then use that for the picking the number. Because if you were to look for this number in a random number table, you'd never find it. So sometimes it's easier just to put them into, sequential. Okay. So we're going to add these up. $33. 748. What you guys got? Yeah, we also just cut and paste this into Excel. That might be a quicker way of doing. That would be a quicker way of doing it. $32,395. Is that what you guys got or no? Put in Excel just to see. Oh, I got that one wrong. Hold on. Did you get 33,795 for this one?
Yes, I got 33,795.
And 32. This one's okay though, right? 32.
Mhm.
Okay, all right. Sorry about that. Okay, so here's the totals. And we want to find the averages. So what do we do?
Divide by 5.
Yep. Divide by 5. Six, 7, 5, 9. That's not me barking. That's a little dog. Right, 6, 4, 7, 9. 6. Okay, so these are the averages for each of them. Now, of these numbers, which one do you think carries more weight? Which one would you tend to believe more? What the client gave you or what you found out for yourself? So
Well,
this,
myself, I would go with it.
yeah, so the audit is actually, this is our best, put it here. This is our best, or more persuasive, let's say. Oops. This amount is actually more precise. This is the amount, because we actually looked at this ourselves. These are the numbers that we came up with. So this is actually the more of these two, the one we want to wait to. Okay, so the book average was 6,795, and the audit average was 6,4. Okay. And we're gonna copy those out of the next page. All right. Yellow, we'll make that green just for kicks. Oops.
Professor, I'm getting a different number for the book average. I get 6,759, not 6,795.
You're wrong. Let's see here. You got 659?
I have 6,759, which is what you're showing on this screen now, but on the page, the working document,
Oh.
you have 95.
Yeah, you know what that is? That's a transposition error. Thank you. 6759. Good catch. Let me change that. So 6759, 6759. Yes, this is some of the last the class last semester. I actually no, I didn't even think about that. Some of you may have had this already in the other class. This is exactly like it is in 330. I do it in both classes because it's one of those things that we test on the CPA exam 100%. So I think what I'll do in the future is when I do the sampling stuff, I'll do it at the back end of class in case you already know it and you already can finish the handout, whatever, turn it in, and but yeah, this is the same stuff. It is, and this most of the stuff I show you on here is they're almost all, except for this first one, they're almost all the way you'll see them presented in the CPA exam. They are actual CPA exam questions, that were, or a similar format that we put in there. But yeah, I didn't think about that, but yes, it is. Okay, so they tell us that the accounts receivable, the book value of the accounts receivable was $200,000. And that $200,000 is what the client says that the books are worth. So if these were, if you were to add all these up, actually, let me add all these up, make sure that does come out to that. It should. It's positive I got this set up for that, but it's hiding my auto sum. I gotta move this. Here we go. Yep, 200,000. So if you were to add all those up, they would come up to 200,000. So this is what the client says, this is the book value. And this comes from the client. So this is what the client says that their accounts receivable are worth. And we have to see, as auditors, we have to go in and say, okay, well, let's see how you got that. And yeah, we'll see how if that $200,000 how that holds up. All right. When it comes to sampling, and this is for any sampling. Gotta change cam. Oh, wait, I need my dog to focus here. Here's my focus dog. That's a dog you heard barking, by the way. It looks just like that. Anytime you do a sample, it's kind of like this. You know, you take a sample and hopefully that sample, it's random. Let me make it. I don't know why mine's so small. Be a little bit bigger. All right. So anytime you take a sample, I'll write the sample first. And then you want to project it onto the population as a whole. Okay, those are also the dog hairs from that little dog that are on that. Okay. And you project it onto the population total. So you take a sample, in this case, we took 5 items, and we're projecting it on a population total, so onto the 30 items. Okay, we took the sample of 5 and we're projecting it onto the 30. And this is for any type of sampling. This isn't just for auditing. This is, you know, if you come out with a new drug, you know, for the cold or whatever, you know, you test it out on a sample of people, you see how it works, and then you try to project it over the entire population. You can't give everyone on the planet the cold medicine and then see what happens. So you take a sample and then project it on a whole. So this is what sampling really is. Okay, let's see, share screen. So that's what we're going to do here. We're going to try to take what we have. Here's our results. You know, that's our sample, and now we're going to project it over the entire population. Okay, mean per unit. Mean just means average. So average per unit. And the average we're talking about is going to be our average because we trust this one more than book one. And not just because I made an error on that one, but because it's the stuff that we did ourselves is more persuasive than what someone else hands to you. Okay. So the audit average was 6,479. The number of items in the population was how many?
30.
30. So we're going to say, okay, everything in the population should be our average of 6,479. Equals 194,370, I think. You guys probably know by now to check that. 194,370.
Yep, correct.
That's it. Okay, good. I was hesitant.
Correct.
I got it. All right. So this is the projected value. So what we did is we took their the average of the items that we picked from their the sample of our 5 items. We projected over their entire population, and we came up with a projected value of 194,370. And now we have to see what the projected misstatement is, because this is kind of the one that we want to look at to see if whether it is a material misstatement. Okay, the total book value is how much?
200K.
200. Yep. The projected value is
194.
so the projected misstatement would be what?
The difference between them.
Yep. is $5,630.
Yep.
Okay, so this is our projected misstatement. Now, we want to know whether this is a projected misstatement is if it's too high or if it's too low. So the book value, is the book value overstated in regards to our sample, or is it understated?
It's overstated.
Good, it's overstated. Yep. They're saying they're saying the book value is 200,000. We're saying, oh no, based on our mean per unit, that it is overstated by 5,630. Now, the question comes to mind is, well, is 5,630, is that material? Now, that's going to be a judgment call. So, I cannot spell for beans. So here's the judgment decision. Okay, so is that a misstatement? It's a judgment call. Now, here's the thing about auditing. And that is that everything you do must be repeatable and must come out with the same results. So going back to the way we chose our sample, we would write down, just like they have up here, pick the first two columns. So anyone doing this testing, okay, pick out of the first two columns the random number table, pick your sample. Now, if someone else came up and did the same test, they would come up with the same items. It'd be random, but they would be the same random items that they would pick. And everybody should come up with this same projected misstatement. You know, if you work this like was, you know, like it is written out, you come up with the same. So everyone will have the same results for that. Now, here's what is not. Whether something is material or not is a judgment call. We will have rules of thumb that we'll talk about a little later. We'll talk about rules of thumb basically as far as materiality, but it comes down to a judgment call either way. And you could have two different people. They get the same number, but you have two different people. One person may say 5,600 is, it's not material. Someone might say 5,600 is material. So that's a judgment, but the 5,600 isn't a judgment. That's a, that's what is misstated by our projected misstatement. But whether it's material or not, whether you're going to make a big deal out of it or not, that is a judgment. And I think I told you this before, maybe I didn't. All auditing is judgment. Okay, ratio estimation. Ratio estimation says that everything is off, that misstatements are made in a ratio of the size of the item. So in other words, big items would be off by more than small items. A larger account might be off by more than a smaller account. Okay, and this, by the way, I think this one might be the most useful one. Okay, we start with our audit average. And we divide it by our book average. And if you forget which one goes on top, it's alphabetical. There's a lot of ratios in accounting that are alphabetical, by the way. Kind of funny. Okay, so it says, okay, there's a ratio here. There's a ratio of what these things, of the value of these. So you have audit average on top, book average on the bottom. So now you're going to multiply that by the total book value. 200,000. And feel free to round this off to the nearest dollar. I know this is not going to come up to a nice clean number, I don't think. $191,715.
Yep.
That's what I have.
Okay. All right, good. All right, so this is our projected value for it. Here. That. And projected misstatement is other number. $8,285. Did you guys get those?
Yep.
Okay. Overstatement or understatement? Are their books too high or too low?
Would it be overstated?
Very good. Oh, wait a minute. So yeah, it's overstated. We're saying that it's worth 191, and they're saying it's worth 200,000. And again, the judgment decision there would be, you know, we know what we projected here.
I have a question, Professor, regarding the overstated understatement. How do you know as far as like looking at the numbers? Are you just a question of how do you know as far as if it's overstated or understated?
Yeah, basically is for most of these, with the exception of the first one, for most of these, if the audit amount is smaller than the book value, it's going to be they're overstated. They're saying that they have each one of these is worth more than we're saying. So usually it goes by the audit versus the book. The mean per unit one can be a little bit tricky because there's only one number there. So it can tend to be a little bit more. It can actually go the other way. Actually, I have one on here that does that. But yeah, so basically you're looking at these two. So if the projected value, this is our best estimate, what it is. This is the best estimate we have. So if we're saying that this is what it should be, if they have more than that, it's overstated. If they have less than that, it's understated. So you're comparing these two to each other. And the amount is important too, because the amount determines whether it's material or not. Is $8,285 material? And if it's not, it really doesn't matter whether it's overstated or understated if it's not material, because we're not going to say anything about it anyways. But yeah, it's a good question. So you're comparing the total book value. Here, let me do it this way. Let me not do it that way. I'll put it down here. Total book value is larger than the projected value. Oops. Then the account is overstated. And just the opposite the other way.
Thank you, Professor.
Is smaller than it's understated. And two, just to make this even more complex, a lot of times it depends on the account too. If as an auditor, rarely do you get sued because a company's doing better than what you had indicated, in your audit report. Usually it's the other way around. No one usually sues somebody if the numbers were actually better than what was on the financial statements. So having said that, so for instance, if it was sales, if sales being overstated is a problem, sales being understated is less of a problem, because you usually don't get sued if a company's doing well. A bank can't come back and say, hey, wait a minute, I'm going to sue you because we gave a loan based on these numbers, but they were doing even better than that. They were even more secure. Well, there you go. There's no monetary, there's nothing there out. So for the most part, you also take into account what kind of account it is. Overstating revenues is a no-no. Overstating liabilities probably isn't too much of a no-no. I mean, you'll look at it and see if it's reasonable, but yeah, it also depends on the account. By the way, I should have something else here. Don't put that on the CPA exam. On the CPA exam, if it's materially misstated, it's materially misstated. And so, all right. Difference estimation. Difference estimation is that everything is off by the same amount. That usually it's if something is misstated, that doesn't matter the size of the account, a $50 account or a $50,000 account, any error will be about the same amount. So it's sort of like just the opposite of the ratio one. The ratio one says, okay, big account, you have a $50,000 account could be off by $500. A $50 account probably isn't off by $50. But the difference estimation one says they're all off by the same amount. And it's usually when there's something in the system that is the same amount, like a handling fee. Maybe a handling fee of $30 or whatever. Sometimes gets added twice, or it doesn't get added in or something like that. That doesn't matter whether it's a $50 account or a $50,000 account. This $30 handling fee doesn't get charged or gets overcharged or whatever it is. Anything will be off by $30. So difference estimation is a little bit different one. I don't think when I was auditing, I don't think I ever used difference estimation, to be honest with you. All right. So difference estimation, you take the difference between the two. Uh, so 6, 4, 7, 9. Where's my, there's something wacky going on here. Oh, I think I know what it is. I think I was supposed to put this as audit. Ah. What'd you guys learn today? Still has no idea how to use a computer. All right. And so then we have this one's even different. I don't know. Okay, forget it. I'm just gonna 6, 4, 7, 9, and we're gonna subtract out this. Now you can tell right from. If we can merge those. Hey, merge so. Hey, there we go. See, 5 minutes later, and I got it. All right, so the difference here now. Now you can tell the difference here. You can tell whether it's gonna be overstated or understated just by looking at these two, the average. This is the audit average. Let's type it in there. And this is the book average. Okay. You can tell right here, the audit average is less than the book. So is this going to be an overstatement or an understatement?
Overstatement.
Yeah, they're saying it's worth 67. We're saying it's worth 64. You know, some change. So yeah, so we know that this is going to be an overstatement. Now here's the weird thing about the difference estimation. You come up with a projected misstatement first. Okay, so let me subtract those.
280.
How much?
280.
280. Thank you. So we're saying, okay, according to our calculations, everything is off by, it's misstated by 280. And the number of items in the population. Need another S here.
30.
30. So we're going to come up with a misstatement of
8,400.
8,400. Thank you. So this one's a little bit strange. And that the misstatement will come first. So this is a misstatement. It is overstated. We're saying that each one of their accounts, they have added $280 to. They have 30 accounts, so here's the total. So coming down here, we have a book value of 200,000. Projected misstatement is 8,400. And it's overstated. So backing into the projected value, what would that be?
191,600.
Yep. So this will be our projected value.
Professor,
Yeah.
why is the 280 not negative?
Oh, you can put it as negative. I mean, yeah, that's another way you can do it is if it comes in negative, that it would be overstated. In other words, you have to subtract 280 out of each one of their. What happened here? you have to subtract 280 out of each one of their accounts to adjust for it. There's no way of thinking about it. So the misstatement, yeah, will be that you have to take off 840 off of the 200,000. That's not a good way to think about it, actually. That a negative would be if it's
But to get
overstated.
it, but to get a negative 8,400 on the bottom, you would be subtracting
Yeah, and that,
$208,400, not 191,600.
well, actually, if you look at all of these up here, you know, it's a 200,000 minus this overstatement. So if it's an overstatement, it would. Did I say it's overstatement or understatement? Overstated. Okay. Yeah. So any overstatement is actually, if you think about it, is sort of negative. It's sort of like you have to. That's what you'd have to pull off of the book value to get to the projected value. So yeah, it's a way of thinking about it. I mean, and again, it has to do with this. You know, if the audit average is lower than the book average, yeah. And yeah, and the if you want to put that in, that's fine. I mean, there's nothing wrong with that. Just as long as the projected value comes out to this, that you take, okay, 200,000 minus 84 will give you that.
Okay.
Yeah. I didn't think about that. You know, I guess all these should be like that. You know, this is actually, you have to take off 56,630. And then again, just like the other ones, the projected misstatement. So 8,400. And so here's judgment. So true or false, three classical sampling methods will estimate let me try reading again. All three classical sampling methods will estimate the projected value for this I think I left a word out here. Let me add a word in here. Add this word in. We'll give you the same projected value. And that is false. They give you different projected values. So notice how much judgment there is in here, though. In this, you know, you think of sampling and then, okay, that's getting, you know, these good hard numbers that we'll know exactly what they are and all that. But there's actually quite a bit of judgment. Materiality, is it material? Also, which method do you use? Do you use the mean per unit? Do you use the ratio? Or do you use the difference estimation? There's a lot of judgment in auditing. In fact, they'll tell you that, you know, in the end, it's all judgment. But you know, even for this fairly straightforward sampling, you know, there wasn't anything crazy in here. We didn't have negative accounts or anything like that. It can. There's a lot of judgment in it. You know, how many items to pick is a judgment? How many? Which method to use? The dollar amounts. Even when you get a dollar amounts, which, you know, is it material or is it not material? Those are all judgments. Which is kind of why auditing can be kind of difficult to learn and to teach. Not to teach, but use in practice. Okay. Let's go ahead and do page 4. I tell you, you know, see if you can work out page 4 on your own. And we'll take a break. We'll be back at, say, I don't know what. Be back at, oh, it's in the middle. be back at, say, 7:10. But go ahead and try these, try to do this one. It's a little bit scaled down. Now you can actually cut and paste, if you want to have these kind of forms to fill in, you can cut and paste those down there. I didn't do it just to save room, but feel free to cut, if you want to cut and paste this and then put in the new numbers, that's fine. Let's see if you can do number 2. Okay, well, first of all, check my numbers. But I think what you should have gotten for each one of them. And you'll notice that the audit average is, for this one, the audit average is larger than the book average. For this first one, it doesn't really matter. For the other two, it does. But the audit average is higher, so it looks like they are understating these the accounts. So going on here, we said that they have a projected value. This is the value we think their financial statement should be. They have 5 million, so there's a misstatement of 314. It's an understatement. They have it 5 million, they should have it at 5,314,000 using this method. Ratio estimation. This is our projected value. And so we're saying that they should just have this on the books for 5,169,000. They only have it on the books for 5 million. So the misstatement is an understated. They're understating it by 169,000. Do you guys got?
I got all the same thing.
I got the same thing.
Okay. If you have a cheap calculator like mine, you might get a funny number. But yeah, the rounding doesn't work on it. But anyway, I should be doing it in Excel anyways. Last one, difference estimation. Just saying that everything is off by the same amount. Everything has been understated by $174. So each account is understated by $174. So this one would be projected value would be, scratch that, projected misstatement would be 174 understated. We think it should be higher than it is. And so this should be their projected value would be 5,174,000. Question on that? And again, it comes back to this, this thing here. In this case, we took a sample of 10 items, projected over a sample of 1,000. Oops. No, we can oops. Get on the same page about. We took that sample of 10, projected over it, said, okay, we use these to project it over the total sample. And again, a lot of, if you're wondering why don't we just take all of them, there's a reason for that. And the reason for it is that oftentimes, especially for large samples, large populations, you can get very accurate taking a small portion of it. It isn't uncommon for it to have 5,000 accounts, and you get 99% accuracy by taking 500 of them. So you can really use a smaller sample. You get very good evidence about the total value from sampling. Another thing is there are some things that you cannot take 100% sample. For instance, I always use the example of a Walmart inventory at year end. If you were to have an inventory at year end at Walmart and count every single thing, there's not enough auditors in the world to do that. You can't do it. So, what you have to do in those situations is to take a portion, of those and project it over the entire population. Kind of like for medicine, medicine's like that. You can't take the entire population of Earth and test medicine on it. It's not possible. So that's why we use sampling. One, it's very efficient. You get very good, a very good, your confidence in the numbers can be very high, 99%. if you take a sample of much fewer items. And then also there are some things you just cannot take 100% sample of. Okay. Let's stop here. We are not going to finish this one today. And let's pull up the, no, not that one. Let's flip to chapter 10 handout. Let's see before I go. Okay. Who did that? What a mess. All right. Oh, lapping. I'm gonna check something really quick. I'm gonna copy this down. So segregation of duties. And coming down here to this lapping example is one of the good example of it. Okay, so let's go through this. Okay, lapping. A custodial clerk receives checks applied to the customer's accounts. The following checks were received by Bedrock Corporation. Okay, what is lapping? Lapping is applying receipts from one customer to another customer to hide a theft. Oops. So you're applying receipt. So you get a check from one customer, you apply it to another customer to conceal or hide a theft. And I'll show you what I mean in a second here. Okay. The accounting clerk receives the checks and applies the amounts to the customer's accounts. The following checks were received by Bedrock Corporation. Okay. So here's Fred, here's Wilma, here's Barney, here's Betty. All right, unfortunate situation. The accounts receivable clerk is a compulsive gambler and he steals the $5,000 check from Wilma and cashes it at the racetrack. The clerk covers the missing $5,000 with another customer's payment. How will the accounts receivable customer conceal this crime? Okay, so this first one is pretty straightforward. They make the check out to Fred, or from Fred to Bedrock Corporation. So they apply the entire amount to Fred's account. Fred's happy. Can I bold all these? Yeah, you can. Okay, this next one. Wilma sends in a check. The payee is cash. This is the check that the receivable clerk takes. So how much is applied to Betty's account? 0. It's a stolen check. All right. Well, the receivable clerk has a problem now. And what is it? The receivable clerk has stole Wilma's check, never put it into her account.
they're gonna think that they have that, like the money was paid, but it wasn't.
Yeah, Wilma's gonna get her statement and it's gonna show that she still owes $5,000. She said, no, I sent that in. Okay, so we have to make Wilma happy. So what we're going to do is, well, Barney just got sent in an $8,000 payment. Let's make this diagram, let's beef it up a little bit. Okay, so what we're gonna do is we're gonna take $5,000 from Barney's and we're going to put it in, so this is from Barney, into Wilma's account. So how much is left for Barney?
3,000.
Yep. So we're gonna take Barney's check and we're gonna apply 3,000 of Barney's check to Barney's account. All right, now now we got a problem not with Wilma, now we got a problem with Barney. So we come down here. And how much do we have to put in Barney's account to make Barney happy?
5,000.
Yeah, so from Betty. We need 5,000 from Betty. Okay, so now we got Barney off her back. How much does Betty still have?
Only
1,000.
1,000, yep. So now Betty's got 1,000. So if these go out, you know, and let's say Betty opens it up and she shows that she owes 1,000, she'll say, wait, what's, or she owes what, 5,000. She'll say, well, hey, what's this? She calls up, they're probably going to transfer her to the accounts receivable clerk. The accounts receivable clerk can say, oh, that's just our accounting system, it's goofy. No, yeah, I show you as a zero balance. You know, it's just got to hit the system. Whatever the accounts receivable clerk comes up with. But it's basically doing this, it's lapping. It's taking from one customer and putting it into another customer's account to conceal a theft. And this is why a lot of times people that do stuff like this, they don't take vacations or anything else because, you know, the fear that somebody's going to figure this out of what they're doing. Now, this sentence right here is kind of how this is just poor internal controls. So the accounts receivable clerk receives the checks. That right there is a no-no. The checks are the assets. There's a value, whatever that is on the check. And which one of these is the clerk's job? Authorization or record keeping?
Record keeping.
Yep. And so this is the these are the accounts receivable. Now, if the clerk has the authorization to write off accounts, that's even worse because then they can just take the check right off the account and nobody knows. But you have to keep these separate. So basically, record keeping should only get, you know, the list of checks that are received. So the segregation of duties, the accounts receivable clerk should never get the checks. You know, this is a problem. Now, you know, the question comes, well, how often do they, and by the way, if the accounts receivable clerk, if they go to Las Vegas and they win a bunch of money, come back and pay this off, it's possible that people never find out about it. So, kind of hard to find, and that's another problem with the having the incompatible duties, is it's difficult to know that this is happening. Okay, so down here, which ways to detect? Man, I think there's more than one here.
A and C.
Yes and yes, very good. Yeah, the take the daily test list with credits to the accounts receivable journal. If they had picked up a $5,000 check coming in, and they looked at the amount was applied to the accounts receivable journal and it was zero, well, that's a problem. What happened to the check? So oops, where am I at? A could have certainly is possible they could find it. Lie detectors are pretty much meaningless. Oops. Sorry. C is a good one. Verify that total amount of each check is entered in the accounts receivable journal intact. And this one, you could catch a number of them up here, because notice you got an $8,000 check from Barney. Well, there should be an $8,000 credit, right? It should all go into the same thing. But if you see this $8,000 and it's split up between two accounts, you know there's a problem, because it should go in at 8,000. So if there's 8,000 in the check register, there should be an 8,000, intact number of 8,000 going into an account. If it's split up, problem. Have all accounts to do with people bonded. Bonding is just an insurance policy. It's not going to stop this. Bonding, having people bonded is just it's insurance against losses. And while it's not a bad thing to do, because they do background checks on people, but yeah, it's not gonna it is not a substitute for internal control, we'll put it that way. Okay. Electronic funds transfer. This is one of those things that I don't know why we even talk about it. Everybody does this nowadays. Oops. Everybody knows about this. So. Transferring funds from one account to another electronically, so everyone has Zelle and all that stuff nowadays. So this isn't that far-fetched. This is kind of like back in the day when they would just talk about, can a computer do? Okay, standard bank confirmation form. Standard bank confirmation form. Oops. Is sent directly to the auditors. That come from the client. Okay, so if you're auditing, whatever, Fred's Auto Sales, you're gonna get the standard bank confirmation form from the bank for Fred's business, and to make the evidence better, you want to get it directly from the bank rather than getting it from Fred. What's the problem with getting it from Fred? Fred will get a bank confirmation. Why don't we just get it from the client?
Just to make sure it's not biased or like affected by Fred.
Yeah, exactly. Fred could be altering the numbers on it and that sort of thing. So Fred doesn't get a chance to do that though if you have it sent from directly to the bank. So Fred will have to authorize the bank to send this bank confirmation directly. And if Fred doesn't do it, then that's that tells you that there may be something wrong. Okay, standard bank confirmation form. And what does it have on it? Included, it will have the ending balances. Just say cash accounts. So what's included? Included is the ending balances for in all cash accounts, the ending amounts for loans or notes payable, any loan agreements, any collateral applied to a loan. So these are all the things that you would see on a standard bank confirmation. The ending balances. Those was included. Included. Sorry. Deposit transactions. Checks that have cleared. Loan payments. So what is included? We get the ending balances, no transactions, though, just the ending balance. This is what they had at the end of the year. Any loan agreements. This is a very important one. Oops. It's not so important that it gets two M's, but still up there. And this one's also fairly important because this will tell you items that they have that for instance, they can't sell. If they buy a car and they get a loan from the bank for the car, they generally can't sell the car out from underneath the loan without, they can't get the title and all that kind of stuff. So these two are really probably the most important things. The ending balances you can get off a regular bank statement, but these two, especially this one, the loan agreement, is more difficult. Question on that? All right. Year-end bank statement. Okay, this is your bank statement at the balance sheet date. For example, if they have a calendar year as their their fiscal year, it'll be that 12/31. You know, this will be the year end. So that's the year end bank statement. And what does it have on it? It basically has all the stuff that was not included here will be included. Teaching you guys how to be lazy like me. It's a very important skill to learn. Very important. Cutting and pasting. Ah, okay, kind of sometimes it doesn't always save time, but by the way, this is also sent directly to the auditors for the same reason as up here. And you'll see the deposit, transactions, checks cleared, loan payments, that'll all be included on the year-end bank statement. And the auditors get it directly. Okay. So this year-end bank statement, that's an important one. That'll have all the transactions and all that. It will go into the bank reconciliation. We'll talk about, actually, the next class we'll start doing some. All right, cutoff bank statement. This is something unique to auditing. Unique to auditing is we have a bank statement that is what they call a cutoff bank statement, and it's there specifically for the auditors. It'll go like 7 to, I think they say 7 to 14 days, however long it is, into the next year. And what they'll do is they'll look at the activity in that span. You know, what's the activity within that the span at the end of the year. So if they have a deposit in transit, for instance, they deposit the bank that didn't show up on the bank statement. Well, that deposit should clear by, say, the 10th of the next month, right? I mean, it might take a day or two to clear, but it won't take 10 days. So a cutoff bank statement is something unique to auditing. It's sent directly to the auditors, and it is it's there because we can verify a whole bunch of different things with it. All right, take a look here. Okay, sent directly to the auditors. Bank statement is usually cutoff bank statement. Usually 7 to 14 days. So for instance, if it was 10 days past, you get one dated 1/10/2024. So what can you do with this cutoff bank statement? Well, first thing you can do is, oops. Oh, sorry about that. Verify amounts in the bank reconciliation below. Unrecorded liabilities. I'll talk about that in a second. So what do we do with it? We verify the bank reconciliation. We also look for unrecorded liabilities. And unrecorded liabilities, it happens this way. Someone gets a bill. Excuse me, let's say it's a phone bill. They get a phone bill. They say, I don't want to put this on the books because this will make us look bad. We have this phone bill. So if I just take this bill and I stick it in this drawer, don't put it in, wait until after year end, then put it back into the system, that, it'll make this year look better. So it's an unrecorded liability. And normally they'll look at, as you can imagine, for auditors, that's hard to find. There is no invoice, or it's hidden from you. They've taken it, put it in the drawer, they lock the key, lock it with a key and whatever. So how do you find it? Well, you find it with this cutoff bank statement, because anything that they write checks for, for these liabilities that they don't record, oftentimes they'll hit the books early, hit the bank early in January, because they have to be paid by then. So a lot of times you'll find unrecorded liability by getting the cutoff bank statement. So the cutoff bank statement will show the things, and virtually anything that is paid, within the first few weeks of anything that cleared within the first few weeks of the year, was probably a liability at the end of the year. Not always. There could be something happened in January 5th, and you had to pay a repairman to come in and fix the copy machine or whatever it is, and you had to pay them immediately. That's possible, but most of the stuff on there, and you can go through and check and see those things that are on there and see if they are legitimate. Basically, are these things that should have been on the books earlier? So if you go through there, you find a phone bill that was from December. You might find that and say, okay, well, this was an unrecorded liability that we need to put on the books. So that cutoff bank statement will help you to figure things like that out.
Professor, I have a question.
Yeah.
So just like this, to think from the editor standpoint, let's say the accounting department, they overlooked some expenses or some liabilities from 2022, and they just let it sneak in the books without in the 2023, and without label it it's related to 2022. How the auditors can catch that?
So they put it in a different year.
I mean, it's related to 2022, and they just recorded it in 2023, and there's no label that or description saying that this belonged to 2022, because it was overlooked from the beginning. So how the auditors will catch this?
Yeah. It really depends on how it goes about it. If it was an honest mistake, it's probably not that big a deal. But if let's say they did it intentionally, there are a few other ways to do it. If it's a recurring amount, it's a lot easier to find. How many monthly phone bills do you get in a year? You get 12. So if they have 11, that's a problem. If they have 13, that's a problem too, because that shows that last year, or whatever, it could have going different directions. But yeah, it can be sometimes they're dishonest mistakes. They just to get it into the system.
Mhm.
I've seen one of the things you always do is you go around looking on to see the receiving reports and things that people have on their desks and so forth that they don't know what to do with. You know, you have people waiting for it. We got this bill, I don't know what account to charge it to, things like that. But yeah, but it is there to pick up those things that, you know. So what you would do is you would, for all those receipts, or I should say payments that were cleared in early January, trace them back, see if they were on the bank reconciliation. If they weren't on the bank reconciliation, you know, the ones that you received, those are probably new checks that were written, and that those were, you go back and look at the documentation for them. But yeah, they call it, these are like kind of like cutoff things at the year end. And the cutoff bank statement is there to actually, it can find quite a bit of stuff. You know, just because of the delay between deposits and written checks. Now today with stuff done electronically, it's a lot less of a problem, but it still can be. You know, it's still one of those things they still do. And usually, if you're wondering, well, you know, what you say 7 days to 14 days, it's a pretty big span. Usually, things like bank and financial institutions have really short ones, you know, 7 days, whereas like manufacturing companies that would have like 14 days. It's kind of wild to look at if you ever look at a bank audits, a lot of times they get those audits done within the first 2 weeks of the year. I mean, it almost seems impossible, but so much of it is electronic and all that. They can get the audits done really quickly. Whereas a lot of times you'll have, you know, things like the manufacturing companies that their audit won't come out for 6 weeks or, you know, or more. But you're talking days for like bank audits and stuff like that.
Okay, thank you.
Yeah. Okay, bank reconciliation. I'm going to hold off on this. And not because I'm lazy. I am lazy, but that's not why. Because we're going to cover this extensively next class. We got some bank reconciliations we're going to do. And by the way, bank reconciliations are one of those things that can almost guarantee is going to be on the exam. Yeah. At least a good month for manufacturing. Yeah, it takes a while. It takes a while a lot of times to get the workout. Okay, so let's go to, we can still answer these two questions though. Which of the following can be verified by a standard bank confirmation? So this is not the cutoff statement, but the bank confirmation.
B and D.
Yep, B, D. And there's actually one more.
Oh, C.
Yep. Yeah. Just the ending balances will be there, but the rest of it, the activities for the month, those will be there. Which of the following can be verified by a cutoff bank statement? I haven't talked about kiting yet. This is all the above.
Yep, pretty much.
Yeah. Kiting, we'll talk about it. Actually, we'll do kiting. I'll show you guys how to do kiting. Somewhere here. This is a huge yeah. All right. Well, there's a lot in cash, but let me go back down to the last one we had here. Make sure everybody got it. Ignore the bank reconciliation for now. There's a huge amount in cash because of this up here. You know, this up here is why we have so much, because it goes, you're really verifying many accounts. You know, you're verifying these accounts payable, you're verifying revenues and all these other accounts when you go through cash. So that's why we spend so much time on cash. That's why this handout is so long, tedious, because really it's it's really covering not just cash, but all these other ones. The cash account is usually fairly small. You know, a lot of times it's not even material. If the whole thing was zero, it wouldn't, you know, it wouldn't matter, except for all the amounts that come in and out of it. All right, any question on that? All right, still nothing to turn in. Next week, I promise we'll have stuff to turn in, but nothing to turn in this week. You know, I think maybe, let's do this, though. Let me give you homework. Let's do number. Let's do number 3. Yeah, do this one for homework. And I think this one comes out a little bit wacky because the understated and overstated are a little bit different. So let's make this thing homework here. And we'll go over it next week. So don't be afraid to, you know, make a mistake or anything. So see if you can do the, you know, the 3 methods for it. And again, there's going to be conflicting over and understatements here, and we'll talk about that too. So let's say number 3 is homework. All right. You're not looking at what I'm looking at. I'm so sorry. Let's try that again, Mark. All right. So on this is on the classical sampling. Number 3. Do this one for homework. And again, the overstatements and understatements will conflict on some of these. All right. Any questions?
Nope, all good.
Do we turn the whole thing, or do you want the just number 3 copied onto its own sheet?
No. Just put it on this one, and don't turn anything in for it. Yeah, we'll turn the whole thing in all at once. So there's
Okay.
nothing to turn in for next week. Any sense? But do it, and we'll put it up. You know, we'll put up the answers and talk about it. The weird thing on that one is that there's some that are overstated and some that are understated. You know, of the 3 methods, which it's quirky, but it actually there's a reason why it happens. Any questions? Okay. Well, if you guys had enough, I've had enough. Meet again next week.
Yep.
Okay. All right.
Have
See
a good night, Professor. Thank you.
you. Thanks.
Professor?
Yeah.
Thank you, Professor. Good night.
Yeah.
You go ahead, dude. Okay. I just wanted to let you know next week we are my hockey team, we're leaving Thursday after practice to go to Wisconsin. So I'm gonna miss the
Okay.
lecture, but I'll catch up on the video after.
Absolutely fine. Absolutely fine.
Okay, I just wanted to let you know. Thank you.
All right. Thanks.
All right, see ya.